Well, speaking of Canada's housing market, TD Bank has downgraded home sales and home price forecasts for the remainder of 2022, saying monetary policy has tightened more acutely than anticipated. That is dragging down Canada's housing market. But could we see some recovery eventually? Joining me is the author of TD's latest report on housing, Rishi Sondhi, economist at TD Bank. Thanks so much for joining us, Rishi.
Thanks for having me.
So I wonder if you could just tell me about, your expectations going into this year in terms of interest rates and, the housing market and just how much they've changed.
Yeah, so we were expecting, heading into the year, we were expecting lesser rate hikes like many forecasters were. Inflation did, prove to be a little bit more persistent than we and other forecasters had anticipated. So that, including Bank of Canada, of course, and other central banks. So that's caused, central banks to act a little bit more forcefully with respect to inflation or managing inflation and with respect to rate hikes. So they've had to push rates a little bit higher, or actually a lot higher, than we had anticipated in the outset of the year. But that said, we are now, in the environment we're in, and we have higher rates, and we think that that's going to, of course, continue to weigh on the housing market activity.
Yeah, we were talking with Bloomberg's Theo Argidis earlier, and he was saying how, if you add this all up, you could be looking at mortgage rates of 6% by the end of the year. So where does that take prices and sales in this country?
Yeah, so we think that, as I mentioned, we don't, there's further downside to the recalibration, I'll call it, that we're in at the moment. We're forecasting a 19% peak-to-trough decline in Canadian average home prices from the first quarter, starting the first quarter of this year. So the first quarter of this year is sort of the peak through the early part of 2023, so 2023 Q1. So 19% peak-to-trough decline in average home prices and a steeper decline in sales, something in the order of about 35% or so over that same time period. So we're sort of, a little bit less, I'd say, than halfway through what we think the correction will be. So there's definitely more downside to activity in our view.
It's interesting, though, even a 19% drop in, average prices in this country, I think that still keeps us well above where we were pre-pandemic. And I know that you've written before about how, prices went to astronomical levels over these past 2 years. Is part of the recalibration just sort of settling into a new normal, but that new normal is not pre-pandemic levels?
Definitely. I mean, the run-up in home prices that we saw during the pandemic definitely was not sustainable, and it was obviously assisted by low interest rates. Home prices went up about 50% from February 2020 to February 2022. So that's a huge run-up. That's absolutely unsustainable. Now we have rates rising, and what that's doing is it's putting pressure on affordability. And when you have rising rates, something's got to give. So we're seeing prices fall at the moment. So with this affordability situation or story sort of deteriorating as rates move higher and sales move lower, we are seeing markets cooling. And we think, as rates move higher and they remain higher than their pandemic lows, that'll necessitate sort of, as you say, a bit of a new normal with respect to housing markets, in that some of the activity or some of the ultra robust, unsustainable gains will be just that. They'll be unsustainable. They won't be sustained in the future, and will be sort of more in balanced market moving forward.
Are you expecting, though, gains to pick back up again more, long term?
Well, yes, definitely. I mean, we think that, the central bank will be forced to lower rates a little bit over the course of next year, just a tad, just to respond to some economic weakness. So as rates kind of come off the boil a little bit next year, we think that'll help put a floor under sales activity. That said, because the level of interest rates has gone up, we think that sales activity, while rising, will remain, lower than what we saw during the course of the pandemic, and perhaps even below what we saw before the pandemic, just because rates are going to be at higher levels. So we will see rising activity, at least we think, and that'll put a floor under prices as well. But the rate of increase in home price inflation and sales or the level of home prices and sales won't be near what we saw during the pandemic.
Rishi, when you're looking at the health of the real estate market in this country, I just wonder, are you considering the labor market in that as well? Because we know, having a job or not having a job can make or break somebody's ability to, make a mortgage payment. And so, if I know unemployment is at a record low right now, but things change and, there's the concern about a recession being on the horizon. Are you taking that part of the economy into, into your equation here in terms of your expectations?
We do. I mean, we in sort of our baseline forecast, we have an uptick in the unemployment rates. We are expecting some softness in the labor market going forward for, as you've mentioned, the economy's set to soften as inflation and higher interest rates take some steam out of consumer spending. And it's a bit of a feedback loop. So you have the economy sort of slowing, and that'll of course weigh on housing demand as well. But we have factored that into our baseline forecast. That said, there's obviously risks to any forecast. There could be some downside to our baseline that we just put out. In that instance, of course, housing demand will be a little bit softer if economic growth is indeed softer. So we'll have to see how that plays out. On the supply side of the economy, it's interesting because new listings, which is a measure of resale supply, typically tend to fall during recessions. However, investor activity has been on the rise in this cycle. So it could be the case that some of the buyers are a little bit over leveraged. So, if economic growth were to soften significantly, we could see, listings pick up a little bit moving forward, which would sort of buck the trend that we've seen in prior recessions.
Interesting on the economic growth front, because real estate, we know, has become a big driver of this economy, of Canada's economy. I just wonder, with the housing forecast that you've outlined, how much do you think that will weigh on Canada's economy?
Oh, it'll definitely weigh through the course of the remainder of this year and probably into the first half of 2023. So we definitely have that. We have a pullback not only in sales and prices, but construction activity to an extent too, as developers struggle with some labor shortages, rising input costs, and of course lower demand. So that is of course factored in our forecast. And we do expect residential investment to subtract from growth moving forward. That said, there are some offsets for residential investment, in particular in the economy more broadly. Population growth, we think, will be quite robust moving forward, and we have seen some signs of that so far in the data in 2022. Of course, Canada is benefiting from a terms of trade shock, positive terms of trade shock in the moment. So that's a good thing. So there's some offsetting factors there that should hopefully sort of underpin economic activity and keep the downturn in housing that we see more of a recalibration rather than a sort of more bearish outcome.
Rishi,